You're listening to the Sound Money podcast of my show, covering the spread on 91.5 WNYE New York. For more news and headlines, as well as our latest interviews, you can visit our website at coveringdelta.com. Joining us now is Dr. Kiriakos Tobras. Dr. Tobras, along with his colleague George Noulas, are the originators of a monumental lawsuit filed on April 9, 2010, approximately 1 year ago. The lawsuit alleges that foreign speculators, specifically primary syndicators of Greek loans, working alongside domestic enablers within the Greek government and within the Central Bank of Greece, facilitated the manipulation of the Greek bond market for their personal financial gain. This manipulation also had the demonstrable effect of pushing the nation of Greece into the arms of the IMF and the EFSF on extremely draconian terms. Dr. Tobras, I have read through your entire lawsuit, and it is really quite remarkable. Before we get into the details of your allegations, why don't you give us a brief background into what prompted you and your colleague, Mr. Noulas, to file these charges?
Look, we don't speak about any personal profit for me or for Mr. Noulas because personally we don't get any profit for that. The profit is what we get as Greek citizens if this fraudulent speculation finally will stop here in Greece because this destroyed the country, destroyed Greek population, destroyed Greek business, destroyed everything in this country, and it is destroying day after day sovereignty of the country. So our profit, it is a profit of a simple Greek citizen who will earn a lot whenever these things finish.
And can you go ahead and explain to us then what you can tell us about the lawsuit, the circumstances of the short selling of the CDS, of the gist essentially of the lawsuit?
Look, here are these charts, what we feel, this file. This is regarding the crime. This is a very typical financial crime identified as financial fraud against the state. This is the specification of the crime up to the Greek criminal law here, but also up to the other European Union criminal laws, because all the criminal laws here in the European Union regarding financial crimes are up and down the same. Mm-hmm. This crime, it was not just a simple crime committed by some single individuals. This is a crime that has been organized. It was a very, very, very good organized criminal plan, organized by a group of persons who were different persons. They were working different business, but all of them, they had a common interest, and the interest was the collapse of the Greek economy.
Explain why that would be in the interest. And from what I understand, the parties involved included primary dealers of Greek debt, along with the Central Bank of Greece.
Yes, I will explain you. Who were the persons and the institutions, maybe, because we don't know if entire institutions are involved in that game, or only single persons making part of these institutions are involved. But in any case, who had the first interest to run this criminal plan, let's say, were the traders of the naked CDS. You know very well because you had this experience in the United States during the Lehman collapse, when also AIG was involved with the CDS that issued on the CDOs of the Lehman Brothers.
Now, CDS, for our audience, CDS, when you're talking about CDS, these are insurance protection against certain debt instruments, correct?
If we speak about regular CDS contracts, this is okay. I agree with you. It is regular insurance against the risk of collapse, against the risk of default. But in the case of Greece, we still don't know if these contracts are regular insurance contracts because we don't know if the issuers were regular insurance companies. Mm-hmm. Because if you don't have an insurance company, from the other hand, you don't have an insurance contract. Because to have a regular insurance contract, you need the issuer to be a regular insurance company with the reserves to guarantee the contract that is going to issue. In our case, what is the specific Greek case, we discovered that the issuers are some offshore companies residing in some offshore islands all around the world. So they are companies that they don't have capitals and reserves to guarantee the contracts that they issue. Mm-hmm. So from the first topic, this is a pure fraud against also the holders of these contracts, even the buyers of these contracts. Funds or individual investors who are investing in these contracts, they are defrauded because these contracts are not regular insurance CDS contracts. So this is the first topic.
So they're fake insurance because, A, the companies issuing them
are not insurance companies.
Are not insurance companies, and they also don't have the reserves.
The ability to pay these contracts, you understand? So these issuers, they were the first persons interested in the Greek collapse scenario, because with this story they were very facilitated to sell these contracts in all around the market, international market. This was the first. How these people did that? These people did that using the reports of the rating agencies, the three rating agencies that you have in the United States.
S&P, Moody's, and Fitch.
Issued on the Greek economy from January 2010 until now. So these ratings, they were reporting numbers and figures regarding Greek economic data that at the moment were not corresponding to the truth. This is the biggest falsity that was done by the rating agencies. It is to present the data of the Greek government debt in a very, very different way from what exactly was at the moment. For example, they said that Greece was the country with the worst data in European Union regarding the government debt, when the Greek government debt was, as a figure, the 179% of the GDP of the country, when the average rate in the European Union was 175. It was just a 4% difference. And this 4% difference on average values could never make this holocaust what is the Greek financial crisis in this moment. And this is the first topic. The second topic, and this is more important, it is that there were other countries in the European Union at the moment that they had very, very worse figures than what the Greek figures were. Let's say, for example, the total debt of Holland, for example, at the moment was 234%. Ireland, 222%. Belgium, 219%. Spain, 207%, Portugal 197%, and Italy 194%.
This is the total debt you're talking about, including public and private.
I'm talking including, yes, public and private. The problem of a debt of a country is not just government debt. It is government debt plus private debt. Because, for example, if you take the case of Ireland, for example, they had exactly the same problem of what happened here in Greece. But their problem was private debt, not government debt. So what is the problem for a country? The real problem of a country, it is the total debt figure, not just separate public or private. So with other countries having huge total debt problems and bigger total debt problems than what Greece had, these rating agencies, they were concentrated by issuing daily reports on Greece. And this created a vicious circle of speculation that brought the situation to what is today. Take, for example, the United States. Which is the best blue chip company at the moment in the United States? Whatever could be Google, Coca-Cola, whatever. Okay, if rating agencies from tomorrow morning and for 12 months, they issue everyday reports claiming that this blue chip company will bankrupt in 1 month, in 3 months, in 6 months, in 12 months, in 1 year, and in 2 years, that will bring the markets to don't trust this blue chip company. That means that even the best blue chip company will never have access in the markets if rating agencies, they claim every day that this company in the short, in the medium, or in the long time will bankrupt. This is exactly what happened here.
So we can say, in other words, that the rating agencies play the role of a public vetting arm or a PR arm. Okay.
Exactly. They did that, and they didn't do that by themselves. They were supporting doing that by a lot of international media, let's say newspapers, let's say websites also, let's say televisions, etc., and by a group of analysts and university professors who, as specialists, they were supporting this rating agency's report regarding the Greek case. I was reading analysis on the Greek economy from people who don't understand anything about what the Greek economy is. I was reading things that for more than 4 months, I don't remember how much time, that they don't correspond to the truth. Because these are those people who did this job to claim that Greece is here, it's there, it's up and down. They did that only for money and for nothing else, because they don't have even the minimum notion of what the Greek economy really is, and some of them, believe me, they even don't know where Greece is. If you show them the map, they could never show you where is Greece.
So when you say
they are experts on the Greek economy, you understand? So this was the organization that brought to the trading of the CDS, because for the reason of these reports issued on the Greek economy, the market of the CDS, of the Greek CDS, grow up immediately.
Can I ask you something?
Yes.
In terms of a time frame, when did this begin? You mentioned that the rating agencies started to downgrade the debt, or to begin to say that the outlook is negative.
From December 2009.
That's when it started.
First publications were between November, December 2009.
I see. Thank you. Mm-hmm.
After that, together with the CDS issued by we don't know who, a second game started, and this game was the naked CDS. That means issuers of CDS selling CDS contracts to people or to entities or to corporations or I don't know to who else, who they were not holders of Greek bonds. So in this case, we pass in a higher step fraud. That means it is a fraud when the issuer is not an insurance company. But when the issuer is not an insurance company and the buyer doesn't hold any government bonds, what this transaction it is just speculation, nothing else. There is not any insurable interest beside this transaction. So the contract is not valid, it's not regular. And the buyer also, he's buying something what he doesn't need. So why he buys? Just for speculation.
Let me ask you something there, because when I read your case, that was one of the things that confused me. Looking at the CDS and looking at the bonds, because you do talk about the short selling of the bonds in the secondary bond.
Another case
right.
Also.
Yes. Now you're saying that it was a naked CDS because the issuer of the insurance did not own the Greek bond that they were insuring.
No, the buyer of the insurance, not the issuer.
The buyer of the insurance didn't. Right. Okay, I hear you. I understand. So you're saying that what happened was people were buying these insurance contracts purely as a form of speculation, to speculate on the Greek economy that the holders of this insurance now did not have any skin in. In other words, they didn't have any exposure to Greek debt, and they simply. Okay, so that's what you mean when you say naked CDS.
Naked CDS.
The same way that Goldman Sachs.
When you buy the CDS without to have any understanding government bond to cover, when you don't have any risk to cover, you understand?
Exactly. So what we saw, for example, with Goldman Sachs and other banks that had loaded up on CDS contracts that they bought from AIG that exceeded their own exposure, so that when they got... Okay, I understand now.
Why those people, they bought these CDS contracts? Because hearing about these rating agencies' reports, they understood that after 3, 4, 5, or 6 months, the rates of the Greek CDS will be very, very high, you understand? So they bought CDS at lower prices, even if they didn't were holders of Greek bonds, in order to resell this naked CDS contract later to the banks who were asking for security for the bonds that they were keeping in their portfolio. You understand? This is again what was done regarding naked CDS.
And these banks, you're saying that these banks that then increased their demand for CDS contracts, they did so because the bonds in their portfolio were dropping in value, and therefore they had to adjust their risk models in order to compensate for that drop in capital. So they had to,
because even the banks, and because they are very, very